Hey everyone, welcome to a brand new episode of In the Money with Amber Kanwar. We've got a returning guest. Rick Rule is back on the show. This is for all of you who love commodities and unfiltered perspective. He brings that. Gold has had a tremendous rally. The last time he spoke to us, gold was $1,000 cheaper. Where does he see gold going from here? And what's the best way to play that? He names names as he often does. And remember, all this month, we are doing our swag giveaway. It is so easy. You guys are taking the swag from me, which I love. Just subscribe and comment, and you could be chosen to get some of that sweet swag. Let's get into it. The information provided in this podcast is for informational purposes only and does not constitute financial, investment, or professional advice. The views expressed by the host and the guests are their own and do not necessarily reflect the opinions of any organization or company. The host and guests may maintain positions in any securities discussed on the podcast. Always consult a qualified financial advisor or professional before making any investment decisions. For over 25 years, Raymond James has been helping Canadians achieve their financial goals. They are Canada's largest independent financial services firm with over 520 dedicated advisors, $88 billion in assets under management, and capital market services. With no proprietary product to push, their advisors are free to focus on the unique needs of their clients. Whether you're saving for your children's education, preparing for retirement, or safeguarding wealth for future generations, Raymond James is committed to guiding you every step of the way. Visit raymondjames.ca today to discover how you can live a life well planned. Rick Rule, returning to the podcast. Thank you so much for joining me.
Thank you for having me back, and thank you for congratulations for the success of your podcast. I'm a fan.
We are still going. You were our second guest, so it was a bit of a gamble, I would say, although I think you helped to alert people to the fact that my podcast is on, so thank you for that. And now you're coming back at a time where, I mean, you can do a bit of a victory lap if you'd like on commodities, particularly gold. When you were on in January, we were talking about gold, 2,600 an ounce, and it had actually kind of waffled, like it wasn't really doing much in the months leading up. And boy, have we now had an explosion. We're up more than $1,000 per ounce. And so now I want to know, Rick Rule, what do you think about that? Because you started the podcast, if people remember, saying you're a contrarian. You like to be where people aren't. Who's not in gold right now?
Well, actually, it's not that crowded a trade. The anti-U.S. dollar trade is a very crowded trade. But the gold trade is surprisingly uncrowded. We have seen a real increase in the gold price, largely due to foreign central bank buying. The flow of retail funds into gold, as measured by the ETFs, didn't really start until 20 weeks ago. JP Morgan Chase said as recently as 6 months ago that the market share of precious metals and precious metals related securities is less than 0.5%, which is to suggest that gold occupies less than 0.5% of American portfolios. The 4-decade mean market share of precious metals is 2%. Should gold's market share revert to mean, that would suggest a 4-fold increase in interest. So while I take your point about the increase in the gold price, I would suggest to you that relative to other gold bull markets, we're in relatively early innings. I would further suggest to your listeners that they consider gold in the context of the prospects for the advancement of the U.S. dollar. If they are happy with the level of debt and deficits in the United States, if they're happy with U.S. governance, if they're happy with the prospect that the purchasing power of the U.S. dollar might increase, or at least slow down less rapidly, then they should sell their gold. Unfortunately, for myself, I don't share those sentiments. I think that $130 trillion in off-balance sheet entitlement liabilities and $37 trillion in on-balance sheet liabilities, put into reference against a $5 trillion gross federal income, tells me that the only way out of our debt trap is to debase the U.S. dollar. The consequence of that is that I see the dollar, quote, at least in U.S. dollars, increasing. By the way, I don't think the U.S. dollar will do badly relative to other currencies. I think they'll do badly too. I think that the U.S. dollar will do badly in absolute terms.
And it's interesting because you mentioned central bank activity. You've seen that reflect that. U.S. dollar reserves in central banks is going down, and while gold is going up. So central banks are already kind of acting on this. You're referencing why you're bullish on gold. Concerns about inflation, concerns about debt. And I think that that's like pretty on brand, right? If you like gold, typically it's because you have two of those concerns. And I'm curious if there have been further developments or further confirmations about those concerns, from January, from when we last spoke. We've had kind of a tariff scare, and then that has unwound. We've now had the U.S. government take positions in publicly traded companies, and I know you're a free markets guy, so I'd love to know what you think about that. Like, how has the last 9 months informed your view?
Well, not so much about gold, but by the U.S. government. That's a new level of idiocy. That's a poorer performance than even I had imagined, and my expectations were low. With regards to gold, my thesis is pretty simple. The U.S. government would have you believe that the deterioration of the purchasing power of the U.S. dollar is measured by the CPI, which I think I mentioned on your show in January as the CP-lie. It's not a cost of living index. When I measure the increase in the price of the basket of goods and services that I consume, granted, I'm a fat old cheapskate who doesn't buy much. It would appear to me that my purchasing power is declining at about 8% compounded. If you compare that with the yield on the U.S. 10-year Treasury, about 4.5%, that means that they're paying me 4.5% in a currency where the purchasing power is declining by 8%, which is to say that they're costing me 3.5% of my wealth every year for 10 years. That makes gold look pretty attractive. If I can hold my own, rather than losing 3.5% real compounded, that looks like a good alternative. And I think that's precisely what people are seeing. I'm old enough, Amber, to remember the early part of the decade of the 70s, the last time that the deterioration in the purchasing power of the U.S. dollar was greatly greater, than the yield on U.S. 10-year Treasuries, which is to say the last time that U.S. dollar savings really, truly didn't work. And that ushered off the greatest gold bull market of my career.
Do you think the setup looks similar? I hear a lot of people talk about the 70s. They argue why this is not the 70s. Some say, this is the playbook. Here we are cutting rates into markets at all-time highs, core inflation at 3%.
The better news than the 1970s is the incredible advancement of technology, the ability to affect economic growth with less capital than we used to. A second bullish phenomenon is that the world is much more global. The world, in many senses, when I was a young man, was the U.S., the U.S., the U.S., and the U.S., and that would be dangerous. It's worthy to note, and I'll return to the bull case for the U.S. dollar and U.S. economy in a minute. But it's worthy to note that at the beginning of the decade of the 70s, gross federal debt to GDP was about 35%. Now it's 120%. There's less string than there was at the beginning of the decade of the 70s. The other bullish factor, frankly, is the inclusion of a whole bunch of people in the workforce. I dare say in 1970, Amber, that you wouldn't have been the host of a podcast. It would have been some old, fat, bald, white guy like me. And that's a very good thing, except for perhaps for some old, fat, bald, white guys who can't compete. But the fact is there's a whole bunch of good news in the economy. The bad news, however, is that government size of GDP in every country has grown. Debt and deficits have grown. The baby boomers who drove the economy for 40 years are taking from it now. Demographics are lousy. And so, in that consequence, things are both better and worse than they were in 1970 at the start of that market. But on balance, I think they're markedly similar. In the United States, we fought the war in Vietnam, which we lost. We fought the war on poverty, which we lost. And we were left to pay the bill. We didn't have enough money, so we inflated away the net present value of the obligations. The same circumstance that we're facing today.
A lot of people are talking not about 1970, but talking about the dot-com era. Geopolitically different, but when you look at a tech-driven rally, the multiple on the S&P 500, when you look at a cyclically adjusted price-to-earnings ratio, which really is a measure of how expensive is the market relative to 10 years of earnings, rather than just looking at it at any snapshot, it is the highest that it's been since the dot-com era. And I know you like to stick in your lane, right? Your commodities, but you must peek out there to say, what is this telling me? Because it seems incongruous that gold is rallying at a time where everything else says risk on.
Well, I think for many buyers, let me rephrase that. For many of the few buyers who are in the gold space, there is some risk on. There is a whole group of speculators who think the fact that the gold price has gone from 2,200 to 3,700 is good. An old school guy like me thinks that the price of something being 50% higher means it's 50% worse. I don't want to take the bait about technology valuations because, as you suggest, I stay in my own lane. I don't know how to spell or pronounce NVIDIA. Never mind analyze it. So describing it or Microsoft as the rest of those or the rest of those things as expensive or cheap isn't something that I can do. The U.S. budget, or for that matter, the Canadian federal budget, if you all ever have one, is something that
it's coming in November.
I'm much better placed to comment on. Those are big numbers that don't involve much technology. I'm cognizant of the fact that market breadth in the broad market is terrifyingly narrow. The gains in the S&P 500 are basically a function of 7 or 8 large cap technology stocks. The consequence of that is that I can't say whether the S&P 500 is overvalued or not, given that so much of the concentration is in names I don't understand. I can say that the broad economy would seem to be faltering. Certainly, I see that in my country. I see reasonably strong jobs growth, but I see the jobs growth being sort of a barbell, which is to say enormous labor shortages in highly skilled occupations and lots of job formation in service industries that don't pay living wages. And real stagnation in the middle, which is, I think, problematic. I'm not an economist, but it would appear to me that some of the economic growth that we hope to get from the increased efficiency due to technology will begin to be constrained because of an incredible and partially, by the way, deliberately implemented constriction on labor. As an example, in my country, the cessation of the HB1 visa, which is one of the dumbest decisions I've ever heard of out of government. And at the same time, the jobs growth in jobs that can't sustain a living wage. I think the economy, at least in my country, is somewhat weaker than is broadly imagined.
So weak economic growth, concerns about inflation, continued concerns about debt. You remain bullish on gold, it sounds like. And I can't remember, I feel like you don't like giving me price targets, even though I love asking our guests. Can you talk to me in baseball terms? I've had to brush up on baseball when I talk to finance guys. What inning are we in?
In addition to not knowing much about NVIDIA, frankly, I haven't played baseball for a very long time. But I would suggest we're in early innings. I would suggest if we have a 9-inning game that we're in inning 3. Let me explain that to you. No, I'm not going to give you a price target. I'm old enough not to fall for that bait. But let me tell you this. In the decade of the 1970s, the U.S. dollar lost, according to the Congressional Budget Office, 75% of its purchasing power over 10 years. During that same period, the gold price ran 30-fold. Now, I'm not suggesting to you that the gold price is going to run 30-fold, having already run 12-fold since the year 2000. But I am suggesting that the U.S. dollar will again, in the next 10 years, lose 75% of its purchasing power.
And that's bullish for gold in your view?
Really bullish. I would suspect that it is likely that in real terms, the gold price stays constant, which would suggest in nominal terms that its rise mirrors the decline in the U.S. dollar. Ergo, a 75% decline in the purchasing power of the U.S. dollar over 10 years should likely result in a nominal gold price increase that is 3- or 4-fold over 10 years.
We have so many questions about different commodities. That's why I wanted to spend a lot of time on gold off the top. And I promise to our listeners, our viewers, we're getting to it. But before we do, something interesting that you've been working on, you've told me, I stay in my lane. I know what I know. I love commodities. And then here you are, you're developing a bank. You got approval for a bank. And, for those who think that Rick Rule is close to retirement, I think he's getting ready for his next big act.
I totally failed retirement, just like you, Amber. It's just I took longer to do it. I've been a bank investor for many years. I built financial services businesses around natural resources, first oil and gas and then mining. And in the consequence of that, I learned a lot about financial services, banking, insurance businesses, wealth managers, asset managers. This is the 7th bank I've had large experience with and the 2nd bank I've started. And so this isn't really out of the lane for me. The idea that I would start a new bank in my 70s is a bit challenging, but I saw a huge hole in the market. We started a bank in 1999, the same team called EverBank, which was one of America's first online banks. And unlike other banks, we recognized that many Americans wanted to save in currencies outside the U.S. dollar. So we were the first bank in the United States to offer certificates of deposit and money market accounts in 29 currencies rather than merely the U.S. dollar. That was a hugely successful deposit product. The people who bought our bank basically discontinued that product, leaving an enormous hole in the market. The second hole in the market I saw, Amber, was that no bank that I'm aware of in the United States offers credit facilities secured by gold and silver. Yes, they don't believe them to be good collateral. I've been in those businesses for 50 years. I think they're great collateral, and I know the market. I know the buyers. The consequence of that is that we're starting our new bank around innovative deposit products and credit facilities linked to bullion. And before we open, we have 18,000 people on the wait list, many of whom are Canadian. I made some reasonably inflammatory statements about the fact that if they had another circumstance in Canada where Trudeau decided to freeze bank accounts associated with people who supported the truckers' convoy, that if he tried to do that in the United States with Canadian dollar accounts at my bank, you can imagine my response. That generated a lot of Canadian interest, saving in Canadian dollars if one wanted, or in 20 other currencies outside of Canada, is something that appealed to Canadians.
And it's been approved. It's been approved by the Federal Reserve. And so when is it slated to open?
We expect that our transaction to acquire and recapitalize a small bank will be fully approved and closed in the first week of October.
So it'll be listed?
No, it will not be listed.
Okay.
It will not be listed. I did that before. No, ma'am. We're gonna run this bank for depositors and borrowers, not for financial services hedge funds. But I would suspect that we'll be open for business, that you'll be able to deposit with us or borrow from us about 3 months after opening. So let's call it early January. We're going to experiment in our systems with our money first. We're going to make our operational mistakes with our own money rather than make operational mistakes with your money. I'm more forgiving of my errors than you would be. So we'll break it in on me before we serve you.
All right. It's an interesting endeavor. And so we'll catch up with you in a few months and see how that experiment has gone when you're fully up and running. That's Battle Bank. For anybody who's interested, battlebank.com. Okay, let's get into the mailbag because we've got all of these questions beating down my door. Okay, so we've asked about gold and we're going to talk those equities as well, but we also have a lot of questions on other metals. We've got a couple on copper. Stephen on X wants to know, his primary copper play is Ivanhoe. What is a second name that I could diversify into, or should I double down?
Depends on how speculative the questioner is. If the questioner is not very speculative, I'd be looking to something like Freeport-McMoRan, very large, low-cost global copper producer. If the questioner is more speculative, I would be looking towards NGEX, one of my largest holdings, a really profound copper discovery backed by the Lundin family, whom I've done business with for 50 years. For speculators only, however. We're talking about a pre-production story.
So actually, we did get a question on NGEX. So this is a good time to bring this in. This is from Rob, who actually picked it up in part because of your recommendation. And it's done so well. It's up 80% from here. I guess they had a royalty SpinCo approved. So the question is, how do you see that playing out from here? You say it's speculative, but out of the companies we're going to talk about, it's got a decent market cap. It's $5 billion. It's not like a couple million strung together. It's up 80% from here. You know, how much further upside and how much of this has to do with your view on copper?
A lot of upside, a lot of downside. I'm a copper bull, but I think copper needs a break. I think the economy is weaker than other people think it is. I know that we're going to have supply shortages in copper over 5 years, but I think we might have a demand shortage in copper over 1 year. I think, too, that the fiscal circumstance in Argentina is deteriorating. A lot of the success that NGEX has enjoyed has had to do with the incredible economic rebound that we've seen in Argentina under President Milei. But there's a run on the Argentine currency. And so I think that this could be a challenging name for people over the next 6 months. I think this is a no-brainer over 5 years. I think this is the most profound copper discovery that the world has seen since Ertsberg-Grasberg in Indonesia 50 years ago. And the fact that it's being brought forward by the Lundin family, who the market has so much trust in, and who has so much experience in Argentina, lends credibility to it. I think it's a name that could challenge people in the next 6 months. I think it's a name that will delight people over the next 5 years.
Okay, so that's good perspective on the time horizon. I'm curious, since we're talking about copper, what did you make of the Anglo-American Tech Resource deal? Do you think about ultimately whether it will get done? Was that ever interesting to you to see how that played out?
I am a tech shareholder. I support the transaction. I think the idea that you merge companies like that could eliminate a lot of duplicate overhead. And those businesses ultimately are valued on free cash flow and net present value. If you take $200 million out of G&A, you reduce G&A relative to assets under management or free cash flow, that's a good thing. I think the corporate cultures have the chance to be fairly similar. One roadblock will be the Canadian government. Obviously, the management teams want the transaction to go, so the Canadian government absolutely, positively will hold them hostage. Governments always see their jobs as being theft. And I think that'll happen. If they decide to steal too much, the shareholders may go elsewhere. This may also propel an over-the-top bid, either for Teck or for Anglo, by a larger consolidator. I hope the transaction takes place. I would tell Teck shareholders that the Keevil family, and in fact all of the control block in Teck, have already signed up. That family has effectively all of their wealth in Teck, and they know a fair bit about the company, having started it. If they believe it's fair for them, I suspect it's fair for me.
Given that you see copper challenged in the near term, we got a question from Rooster on X, who wondered if you had any opportunities in junior copper players. And typically, if you're looking at the junior players, you're looking for more torque. when the upside is the upside, but they can really get pummeled on the downside.
Yeah, certainly some of the copper explorers are turning in very good results. I would say that the one that's the least challenging is probably Entree Gold, which ironically is a gold-copper story, in Mongolia, where Rio Tinto's Oyu Tolgoi deposit is drifting towards the Entree ground. That's a when question, not an if question. That'll come.
And
It's
Entree,
extremely thin. So don't take what I just said as an excuse to put a market order in. By all means, if you're going to do it, use a limit order. You need to make an appointment to make a trade, and I don't hold the order, the appointment book. Certainly, Marimaca has delivered some absolutely spectacular results. So that's a name that one would consider. There's a variety of junior names. I'm leery, Amber, given the size of your audience, to talk about market caps that are too small. I remember on the show sponsored by your prior employer, we accidentally blew up a couple of market caps.
we don't want to do that. And Entree is a small cap. Just today, for example, only 80,000 shares traded, so super thin. But if you do want to do your homework on it, the ticker is ETG. We also have to talk, Rick, about silver. I know people are probably screaming, saying, "When are you going to get to silver?" Because it's having sort of a great moment right now. I'm just trying to look at the chart and see, how good is this relative to how it's been in the past, sort of multi-year highs for silver. And so broadly, what is your view on silver? And are you as bullish on silver as you are on gold, for example?
As a speculator, I'm more bullish on silver. I need to say, I own gold as a store of wealth. I actually save in gold. I maintain liquidity in dollars. Silver's different. Silver's a speculation. My experience has been that sort of midway through a precious metals bull market, when the generalist investor is attracted to gold's momentum and the precious metals narrative, and he or she comes down into the precious metals space, silver tends to outperform gold. And silver's performance in the last 3 weeks would suggest that we may be at that moment. The trader in me, which is a small part of who I am, tells me that silver may actually break out in October. If it doesn't, I think it's a matter of time. I remember well prior bull markets where I was attracted to the gold move and I was astounded by the silver move. And I expect that past is prologue. The asset class that has likely the most upside is that very, very, very small club of high quality silver equities. The combined market cap, and I'm not talking about all the little nothing nowhere silver companies that don't happen to have any silver. They're just looking for it. I'm talking about the ones that actually have some silver. Their combined market caps aren't large enough to handle the amount of capital that's going to come into them. I remember very well as a young man in the decade of the 70s, the shares of one penny dreadful, Coeur d'Alene, went from 10 cents to $65 in 10 years. Sadly, I was too inexperienced and too poor to take advantage of it. But the next silver bull market, we financed Pan American at 50 cents and Silver Standard at 72 cents, both of which 5 or 6 years later were $40 stocks. The upside in these things, when the stars align, is insane. Truly insane.
So, we've seen this big run. Silver is at the highest level since 2011. And from there, kind of peaked out at this price and then spent years kind of going down. But it sounds like you're saying you're watching to see if it breaks above that. And if it does that, maybe that makes new highs. We got a couple of questions on your favorite silver developers on the Canadian exchange. Do you have a favorite?
I don't have a favorite, but I can tell you that I own New Pacific, which isn't a developer, it's an explorer. And I also need to say it exposes you to a lot of political risk. It's in Bolivia.
Okay.
I own Vista Silver, I own Abra Silver, and I own Aya Silver. Those are, the last three at least, are all post-discovery companies with established reserves and resources that are, I think, strongly economic at today's silver prices and are 100% guaranteed to attract the construction financing that they need to build their mines. This is the least speculative aspect of a speculative portfolio, and they are the ones I own.
So, on that nature of playing it safe in silver to the extent that you can, we got a question from Adam. Pure play silvers, they're great. The reward is high, but so is the risk. In your mind, is there a silver play miner that's not a pure silver miner, like a Pan American, Agnico, Discovery, any other miner that you think can capture some silver upside?
Well, you asked me the question earlier about developers. If you're talking about silver-centric companies, there are many more in my portfolio. The highest quality is Wheaton Precious.
Hmm.
The second highest quality is Pan American, which gets most of their revenue from gold. There's a silver company in drag on the Canadian exchange, Go Gold, which I quite like. It is a developer and it is silver-centric. Constructing a real silver portfolio involves moving out of Canada. The big names there would be Buenaventura, which trades on London but is a Peruvian company, or Fresnillo, the highest quality silver company, silver deposit in the world, which is in turn controlled by another name that silver-centric investors should consider, called Peñoles. Those companies involve understanding something about the political risks in both Peru and Mexico, which, by the way, are not insubstantial. But if you are silver-centric rather than Canada-centric, you need to pay attention to those names.
I'll just take two that you mentioned, Wheaton Precious and Fresnillo, because they're so large. Silver's up, call it 50% so far in 2025. Wheaton Precious is a double. Fresnillo is a more than triple. Is that kind of the expected behavior because you've seen these cycles before? Sometimes these mining stocks can actually be slow to the commodity move, and that's not the case in 2025.
Certainly that's right. I would suggest to you that metals prices, both gold and silver began to move in 2022, but the margin expansion didn't begin. It's important to note in the silver business that say you're a $20 silver producer, and say the silver price goes from, let's say that it's at the beginning of the period that you're looking at, silver selling for $30, so you have a $10 margin. When the silver price goes to 40, an increase in the silver price of 25%, your margin doubles. And that's the sort of leverage that's inherent. I would also point out to you that $44 silver in historic terms is understated. Because we're talking about nominal terms. If you look about what the U.S. dollar buys, if you were to adjust the numerator, the U.S. dollar, back to the last time that silver was at $50, my suspicion is that it would take $125 silver to mark a real as opposed to a nominal high. And I think people need to understand that, which is to say $44 is not the same today as $44 was at the time of the last high in 2011.
That's good perspective. We got a question on a financial that tends to do well when resources do well. This is on Dundee. And if you look at the 1-year chart, you think, my goodness, this thing has gone parabolic. If you zoom out to say over the last, 20 years, you can see that it's spent a lot of time languishing. And now this $4 stock looks great compared to where it was, a few years ago when it was a penny stock, not so great compared to, a couple, call it in 2013 when it was like a $23 stock. So it's been a journey for Dundee. The question is, do you like the CEO and what do you think the company looks like 5 years from now?
I have a lot of time for Jonathan Goodman. His father, Ned Goodman, was an important mentor of mine. I've done business with the Dundee family since I was in my early 20s. Take the rest of my comments in the context of the fact that I'm a large shareholder of Dundee. So there's a lot of bias here. A year ago, the company was selling at half NAV. That is, if you took the value of its securities holdings and added them up, the market capitalization of the company, giving no value to the ongoing concern, was 50% of the breakup value. That was kind of a no-brainer. Not kind of a no-brainer. It was a no-brainer. And the stock is, as you suggest, volatile. The company was born out of the transaction where one of Ned's predecessor companies, Corona, was sold to Homestake, and the merchant banking operation was spun out of it. That Dundee Corp was spun out at 60 Canadian cents, and if my memory serves me correctly, over the next 6 or 7 years, advanced from 62 cents to $42. I had the good fortune to be a participant in that, and it was one of the great financial events of my life. Move forward, Dundee Corp, towards the end of Ned's life, made some pretty spectacular mistakes. An African oil adventure that didn't work out, a casino in Vancouver that was over-leveraged, and Jonathan had to spend 3 or 4 years reorganizing that company. He's done a spectacular job, an absolutely spectacular job. The caveat I have with Dundee Corp is that the stock has done so well in the last year. It's no longer necessarily cheap. Now you are betting on the company's ability to do superior due diligence, I believe. You're trading on the honor and the expertise of Jonathan Goodman, I believe. My only holdback on the stock, frankly, is that a substantial part of the net asset value is a biotech company, which I don't know anything about at all. I have no idea how to value it. So I carry it in my valuation of the company at 0. It's probably worth more than 0, but given that I don't know what, it's easier for me, not easier, it's more appropriate for me to value it at 0 since I don't know what the value is.
We got a question still in large cap land. Agnico and Newmont Mining have sold their stakes in Orla Mining. And of course, Orla dropped when this happened last week. Is that a sign that there's something suspect with the company or a time to purchase shares as senior miners liquidate non-core assets? This one coming from Nick on X.
Orla has been a spectacular performer over 3 years. And I think the circumstance that both Newmont and Agnico were looking forward to took place. And I think if you anticipate a capital spending cycle, which you're going to have at both Newmont and at Agnico, if they didn't sell Orla, they would be telling the market that Orla was a better buy than either Agnico or Newmont. And I don't believe that either of them consider that to be the case. Answering the question, one would need to look independently at Orla and decide for oneself whether the price, the enterprise value relative to net asset value was attractive. I am no longer an Orla shareholder. I was a fairly large Orla shareholder, and it's satisfied, Amber, every level of greed I have. I'm not an Orla shareholder because it underperformed. I'm a shareholder because it overperformed.
All right, good perspective. We get so many questions for you, and some of them do tend to be on the small cap side. So it's not for everybody. Very thin, illiquid, and you might not just be interested in it. You might be interested to own some of the large caps that Rick is going to talk about. So what I'd like to do now, Rick, if you're game, we got like 5 questions, smaller cap questions. We'll just do a rapid fire. Very simple kind of call on it. We got a question from Goose on X. Could I get your take on Fuerte Metals? Big move recently, small cap, $250 million. Do you like it?
I sort of like it. I have the advantage of having been, sort of positioned when the company was being formed. I have other junior names I like more, but this thing is extremely well backed. And it is a company that, if I'm right about the direction of precious metals equities, could do well. But this is one for the speculators only.
ECOR Resources, it's a royalty company, up 23% so far this year.
I love ECOR. That doesn't mean you should go out and buy it. It's extremely thin. Use good till cancel limit orders. I have a large position. That position will get larger on any weakness.
That ticker is ECOR, if anybody wants to do homework on it. We also got some generic sort of questions on industries. Do you have a favorite rare earth play? This one coming from John in Calgary.
The one that I have the largest shareholding in is Meteoric. A lot of challenges in front of them, very large upfront capital costs, some political, social, environmental challenges. There is another company in the same deposit whose name, sadly, I forget, an Australian company operating in Brazil that I'm attracted to. I'm also attracted to Aclara, which is different than Ecora. Aclara is a spinoff from the Peruvian silver miner Hochschilds, which I'm attracted to. I'm attracted to the rare earths space. It disappointed investors in the past, so there's a lot of people who hate rare earths. I love hate. I'm attracted to the geopolitical disputes between China and the rest of the world over rare earths. So I'm attracted to the whole space. My largest position, as I say, is Meteoric. Extremely thin.
What's your thesis? Is it, everybody says that the demand is going to be huge when you look at, all the technology and innovation that's going to be necessary or that will create demand?
So yes, demand for magnets, which is what you use rare earths for, micromagnets, is going to grow and grow and grow and grow and grow. And there are geopolitical disputes around a whole range of technology metals. The Chinese control the rare earths business, and they're beginning to weaponize rare earths the same way the United States weaponized the US dollar. The thing that most people don't recognize is that rare earths aren't rare. We don't look for them because they were so cheap for so many years. They were cheap because the Chinese were such efficient producers. And they were such efficient producers in turn because they tolerated horrific environmental destruction in the production of rare earths. Things have changed in China. China is not poor. The Chinese people and the Chinese government is no longer tolerating the mining methods that made Chinese rare earths so cheap. And as the production costs around Chinese rare earths increase, the floor price around rare earths increases too, irrespective of geopolitical challenges. So deposits that wouldn't work 3 or 4 years ago will work in spades 2 or 3 years from now. That's what I like about it. There's a factor in the market, which is to say rapidly increasing Chinese production costs that I think will underpin the market.
Okay, that's good perspective on rare earths. Let's round this rapid fire out with the view on uranium. We did get a question from Trish on Laramide Resources, which is small, but also just curious on your thoughts on uranium in general. I mean, talk about breakout from small to large caps. And again, it goes into that thesis, energy demand, nuclear revival to feed all of these data centers we're going to need to power AI.
10 years uranium's a no-brainer. An absolute no-brainer. The world by 2040 is going to need twice as much electricity as today. And there is less and less tolerance for carbon-generating electricity. Meanwhile, for baseload, non-carbon generating electricity, wind, solar, doesn't work. So you're left with uranium. There's supply deficits now. I need to say, for the smaller uranium equities, they have absolutely been on fire. Mm-hmm. And they have proceeded from a year ago where they were roundly hated to the point where they're not hated anymore. And so I've sold about a third of my position in the junior uranium companies simply because the easy money has been made. The easy money was the move from hated to not hated. I have increased my position in Cameco because I believe that to be the real uranium company. And while it's conceivable for me, easily conceivable for me, that Cameco could give up some of the gains it's enjoyed recently, I suspect that over the next 5 or 10 years, Cameco will reward me handsomely. And to the extent that the better uranium juniors decline, I'll re-enter them. It's just I got so much money so fast, Amber, in those names, I thought it remiss not to take some.
That's how I feel when I make too much too quickly, which I guess is that's a limiting really problem. That's a nice problem to have.
Yep.
Rick, when we spoke with you in January, you gave us your pro picks. And as a returning guest, we are going to look back at those pro picks. And even though we talked to you about mining and everybody thinks about you, the mining guy, you kind of surprised us with a lot of energy picks: ARC Resources, Tourmaline, and Peyto. Let's go through them because ARC and Tourmaline have kind of disappointed since then. They're flat to down. Peyto's been a nice, run. It's up 20%, and that's done well. I think Tourmaline, and maybe as a surprise to investors, everybody loves Tourmaline. Everybody loves micros, and the stock is languishing, I think, at around a 3-year low the last I checked. So talk to me about whether you still hold them, what the thesis was, and where we go from here.
I have steadily increased my position in the Canadian oil basket. For people listening this time who didn't listen last time, I suggested that oil was cheap and Canadian oil was particularly cheap because of the political headwinds. One particular headwind, your former prime minister, whose name began with T, is no longer a headwind. He was thanked and excused. It remains to be seen whether Canada's most efficient industry will enjoy the favor of Canada's government. If it does, if Mr. Carney decides that he needs the ability to pay for all of his promises, Canadian oil and gas would do extremely well. I consider the U.S. oil and gas industry to be undervalued, and I think the Canadian oil and gas industry is undervalued relative to the U.S. oil and gas industry. I have a list of 7 or 8 Canadian oil and gas names that I own, and I've been steadily adding.
And
are they in a bull market as defined by a breakout? Absolutely not. Are they relatively cheap? Not relatively cheap. Are they absolutely cheap compared to what they're worth? Absolutely.
And the names that you picked skewed more to the gas side. And I'm, why was that? Is that still a preference that you have?
It's still a preference, but gas is much less oversold than it was a year ago. Canadian gas may be less recovered. The U.S. gas names that I liked at that point in time have done well. The U.S. gas prices doubled in that period of time. And so sentiment towards producers has increased. I just looked at enterprise value relative to net asset value, relative to what's called recycle ratio, the ability of companies to use margin to increase reserves. And the Canadian producers just absolutely, positively stood out. I also put a lot of credence myself on management phone calls. And although I've been in the oil business for 15 years, when I talk to the ARC management team on the phone, I'm reminded by how little I know. With regards to Tourmaline, their 10-year performance has been absolutely spectacular. Their focus on adding net asset value per share, not in a gross sense, but per share, which is what matters to me, attracts me. And Peyto, if you look at their exploration efficiency with regards to adding BTUs, and the relative cheapness that both Peyto and Birchcliff exhibited at the time we talked, it was just too cheap not to buy.
All right, so you're holding on to all 3.
No buying, not holding.
Not holding on, buying. Okay, I like that. Okay, that's a look at the pro picks that you came on with in January. Now let's take a look at your pro picks for today. ProPicks is brought to you by ATB Financial. With $62 billion in assets, ATB Financial is powering possibilities for more than 820,000 financial services clients in Alberta and beyond. ATB's capital markets arm is a full-service investment dealer that offers investment and corporate banking, sales and trading, institutional research, and risk management. Visit atb.com/inthemoney for more information. Okay, let's get into these pro picks. And, I'm trying to string together a theme. All it is their commodity plays. And Rick, you were very thoughtful about who's listening to this podcast. So it offers a lot of diversity. There's a large cap in there. There's a financial. There's a bit more of a smaller play. Let's start with Sprott. Sprott is back in a major way. That's one of your picks. It's the highest since 2011. You said on a previous chart that, maybe some of the easy money has been made on a stock that ran up this much. I'm guessing you don't feel the same way about Sprott?
Well, first of all, I need to disclaim the fact that I'm the largest Sprott shareholder. So I'm really, truly talking my book here. But the thesis goes like this. Sprott's a brand name for precious metals, and I think we're in a precious metals bull market. Sprott's AUM has doubled in 2.5 years, which means its management fees have more than doubled while its costs haven't doubled. It generates a lot of free cash. It's paid off all its debt. And the assets under management are growing fairly rapidly. I would suggest that investors, particularly Canadian investors, think about it in the following fashion. If they want to be in resources, they could buy one of Sprott's many products and pay Sprott a fee, or they could buy Sprott, own all of them at once, and get paid a dividend. I'll leave the arithmetic to you. Pay a fee or get paid a dividend. My suspicion, this is not inside information, my suspicion is that AUM goes from 40-something million US to 100 million US in the next 3 or 4 years. And Sprott gets taken over by a Manulife, by a BlackRock, by a Credit Suisse. Somebody who decides that they've ignored natural resources for 40 years, needs a natural resource franchise, and decides that they don't have 10 years to build one, so they have to buy one.
I mean, you'd have to assume, that your thesis is right too on the cycle lasting, right? These players aren't going to come forward if gold all of a sudden isn't doing what gold's been doing.
If you don't believe that we're going to have, on the one hand, a precious metals bull market and later a broader natural resources bull market, none of my picks make any sense.
Okay, that's good disclosure. EMX royalty, again, not really a household name, smaller market cap, sub $1 billion, 675 million, metal mining royalty. What do you like here? Again, a very parabolic chart this year.
EMX was selling at a huge discount to what it was worth, and that discount is being arbitraged away. The company has announced a merger with Elemental, a different royalty company, that merges the commercial acumen of the Elemental side of the access to London capital markets with the extraordinary exploration expertise of EMX. These companies generate as opposed to have to buy royalties. The icing on the cake, I would suggest, is twofold. One, EMX has a large royalty over the Timok magmatic complex in Serbia, where Zijin is now running 16 rigs on a discovery that they won't talk about. But you get to gather all you need to know from Landsat photos of 16 rigs running from a major mining company, and the fact that post-merger, the new financial services giant, Tether, is investing $100 million in the combined companies, saying that they will support both the exploration and the royalty acquisition activities of these two companies. This is easily the fastest growing junior royalty company on the planet, and one that has the unique competitive advantage of being able to generate their own royalties through third-party funded exploration, enjoying the explicit support of a brand new name in financial services, and one of the true giants in money management, Tether. Access to capital and access to the technology-based investment pool that Tether enjoys gives, I would suggest, Elemental EMX a real advantage over their peers in the royalty and streaming, in the junior royalty and streaming space.
Tether, like the crypto Tether.
Yes, ma'am.
Yeah.
Yes, ma'am.
Just like putting it all together. Why are they involved in this?
The Tether's the biggest gold buyer on the planet right now.
Because it's backed.
Correct.
So that's why they need it.
And I have it on reasonably good authority. My former firm, now SCP Capital Partners, was the advisor for Tether in their original journey into Elemental. The Tether people have come to understand the gold story. They've become intrigued by the gold story. And they were looking for an intelligent way to enter the upstream gold space, and decided that royalty and streaming, which is to say financial interests, were probably a better way to cut their teeth than operating interests.
Wow, worlds colliding, crypto and gold
Yes, ma'am.
together. Okay, your last one. People have definitely heard about this one. So you've really dealt with the spectrum of people who want something speculative, something spicy, and this Exxon. But honestly, Exxon is obviously huge, but it's sort of underperformed. What's to get so excited about Exxon right now?
That it's underperformed. It's cheap.
Mm.
The big thinkers in the world, that noted energy physicist Greta Thunberg, Mark Carney, people like that, would suggest to you that oil has entered the era of the dodo. They're in fact saying that peak oil will occur in 2032. Amber, peak oil demand won't occur in my lifetime. I don't think it'll occur in your lifetime.
Mm.
And the net present value calculations that people are valuing oil and gas companies on suggest that the end of oil and gas free cash flow is 2032, which is ridiculous. I think that Exxon is selling for half net present value. It's the best capital allocator in the oil space. They've made a discovery in Guyana that's big enough to move the dial on Exxon. While the industry as a whole, worldwide, is underinvesting in sustaining capital to the extent of $2 billion a day, Exxon isn't merely making sustaining capital investments. It invested $60 billion buying Pioneer to double down. This is simply the lowest risk bet in the energy business. And the energy business, by energy I mean now conventional oil and gas, is the single cheapest aspect in natural resources. And Exxon is an absolute bellwether. In terms of capital allocation, it is easily the best major company performer over 20 and 30 years.
Why not pick a Canadian company, which you could argue is even cheaper?
Because they have less safety. Exxon is the largest, most muscular, and most well-run company in the world. And Exxon doesn't have to suffer under a Carney discount. The world itself is not saying, except for perhaps in photo ops, that all of their investment decisions are carbon-centric. You have countries around the world who understand that the road to economic prosperity is carbon-centric, whether they choose to admit it or not. And the political headwinds that the Canadian companies face from Ottawa is something that constrains the growth of Exxon much less.
You know, there's been a lot of M&A and consolidation activity in the Canadian oil patch. It's all been pretty much made in Canada solutions, a Canadian producer taking over another. There's a hostile takeover right now taking place for MEG. I wonder, do you think we'll see foreign players come back to Canada rather than divest away from Canada as they have been?
I don't think so, because I think the political climate around the Foreign Investment Review Act is such that the Canadian producers will be protected by Ottawa. I think they need to be protected from Ottawa, but that's a different question. And I also think that there is sufficient capital and sufficient expertise in Canada that there is a lot of room left for horizontal consolidation within Canada without having to involve foreign players. The Canadian capital markets are not capital short. And the Canadian oil and gas industry, despite the fact that it's underperformed in equities markets, have performed extremely well corporately. These companies, which exhibited fairly challenged balance sheets 6 and 7 years ago, are swimming in cash, absolutely swimming in cash. And they have very, very deep human resources, very deep talent banks. I would suggest that the talent banks in Canadian companies relative to market cap substantially better than they are in the U.S. This is a rare set of virtues. And I would suspect that having the need to merge, the capital to merge, and the expertise to merge, that you're going to see a lot more made in Canada M&A activity in oil and gas.
Rick, it has been an absolute pleasure. We always learn something, actually more than something, when we speak to you. Thank you so much for joining us on the podcast.
Amber, always a pleasure, and congratulations again on the incredible growth and success of your channel.
Thank you so much, Rick Rule, who was our second guest ever on the podcast. Our first guest ever was a gentleman named Eric Jackson, and you may have heard of him recently. He's been leading a meme army around Open Door, but just this week, he announced his next big idea. It's a company called Better, and we're going to have a chance to talk to him about this journey that he's been on since he spoke with us in January. Don't miss that episode, and if you've got questions, you can email us at questions@inthemoneypod.com, and we'll catch you on the next episode.